If you're tuning in right now, you are expecting the daily Bitcoin briefing, and you know that the last 24 hours, well, they weren't just about price movement. They've been a real inflection point.
Yeah, that's right.
We have been staring down a profound conflict in the market, really a battle between long-term institutional maturation and this really difficult short-term liquidity stress.
That tension is palpable,
Yeah.
and it completely defines the trading environment right now. I mean, structurally, the ecosystem has never been stronger. We are talking major U.S. bank integration, the most significant regulatory clarity we've had in years. The institutional scaffolding is being built as we speak.
But at the same time, the tactical picture is just deteriorating. We're watching global macro forces aggressively tighten, sucking capital out of risk assets everywhere.
And Bitcoin is right in the middle of that squeeze.
Exactly.
And that pressure is forcing a defensive consolidation right now. It's holding that crucial $87,000 to $88,000 corridor.
So our mission today is to really understand this split personality in the market. We have 3 core events from the last day: a massive macro pivot from a central bank, the launch of a revolutionary stablecoin, and a major U.S. regulatory regime change.
And we need to unpack them all to determine which signal, the foundational long-term strength or the immediate tactical weakness, is going to dominate in the next few weeks.
Okay, let's unpack this by starting with the storm cloud, the one hanging over global markets because it originated in Japan. We're talking about the Bank of Japan's decision, which is arguably the most consequential move impacting global liquidity this week. What did the BOJ actually do?
So the BOJ, under Governor Kazuo Ueda, finally and unanimously decided to raise its short-term policy interest rate by 25 basis points.
Okay, 25 basis points.
Pushing it to 0.75%.
And for those who don't follow Japanese economics every single day, tell us why that specific number, 0.75%, is so monumental.
It's monumental because it effectively ends decades of zero and negative interest rate policy, what traders call ZRP and NIRP. This 0.75% rate is the highest Japanese borrowing cost since September 1995.
1995, wow.
For nearly 3 decades, the Japanese yen has been the world's cheapest source of funding. That era is now over.
Think about that. There are entire generations of traders who have never operated in a world where Japan has meaningful positive interest rates. What was the central bank's rationale for finally breaking this historic policy after all this time?
Well, Ueda cited a strengthening virtuous cycle. That's his term.
A virtuous cycle.
Yeah, of wage growth and inflation. Japan's core inflation has stayed above their 2% target for 3 straight years. They're confident enough that they've broken free of that deflationary mindset, so they feel they must normalize policy now to prevent the economy from overheating.
Now, here's the paradox that confused everyone right after the announcement. When a central bank raises rates, the currency should strengthen.
It should.
Yet the yen weakened. It pushed USD JPY toward $157, and Bitcoin saw a brief relief rally from around $84,000. Why did we see that counterintuitive reaction?
It's classic sold the fact behavior. This 25 basis point hike was nearly 98% priced in by the market.
So everyone knew it was coming.
Everyone knew. Traders who had bought yen hoping for the hike just immediately unwound those positions once the news hit. Plus, Ueda's forward guidance was interpreted as pretty cautious. He basically signaled that the pace of future hikes would likely be slow.
So the immediate relief rally for risk assets was just the market exhaling. But here's where we need to get into the structural threat, because the market is often slow to process the true costs of these macro shifts.
That's the key insight. The delayed threat. This is what we call the yen carry trade threat.
Okay.
For years, leveraged global investors, think hedge funds, proprietary trading desks, have borrowed yen at basically zero interest, converted it to U.S. dollars, and used that cheap capital to buy higher-yielding assets like Bitcoin, U.S. equities, you name it.
And now?
Now, when the BOJ raises rates, it raises the cost of maintaining those borrowed yen positions. So if the yen suddenly strengthens, meaning USD JPY drops significantly, those leveraged investors face margin calls.
They're forced to deleverage.
They're forced to deleverage. They have to sell their risk assets, like Bitcoin, to pay back that increasingly expensive yen loan.
I hear the historical context, but why should you, the listener, believe this threat will materialize this time when the immediate reaction was the opposite?
Because our sources show the historical correlation is incredibly sticky, even if it's delayed.
So we've seen this before.
Oh, yeah. In previous instances where the BOJ tightened, like March and July of last year, that initial market shrug was followed by a 20% to 30% Bitcoin correction in the following 4 to 8 weeks.
4 to 8 weeks, so it takes time to work through the system.
Exactly. as that liquidity drain slowly works its way through. So this relief rally may be deceptive. If the yen eventually strengthens and USD/JPY reverses to trade below 154, expect that capital repatriation to become swift and, frankly, painful for crypto. That is the tactical headwind we are now facing.
Okay, so we've established the macro headwind, but now let's talk about the institutional tailwind, because these are two completely different stories fighting for dominance right now.
A total clash.
Let's pivot to the institutional breakthrough that everyone is buzzing about. SoFiUSD.
This is a genuine paradigm shift. I'm not exaggerating. A 0-to-1 moment. The headline is that SoFi Bank, a nationally chartered OCC-regulated bank, has launched a stablecoin called SoFiUSD.
Hold on, we've heard about JP Morgan's coin and other attempts. What makes SoFiUSD so revolutionary that our sources are saying it obliterates the firewall between regulated banking and crypto?
Two things. First, the regulatory status. SoFi Bank is chartered by the OCC, the Office of the Control of the Currency. They regulate all national U.S. banks, so they are operating fully inside the U.S. regulatory perimeter.
Okay, that's big.
And second, the technology. Unlike JPM Coin, which operates on a closed private ledger, SoFiUSD is issued on the Ethereum public blockchain.
The public chain.
Using the ERC20 standard.
What's the significance of using that ERC20 standard? Why does that matter so much?
It's the validation that the crypto world has waited for. It means a regulated national bank is choosing public, permissionless rails for enterprise finance. It is confirmation that Ethereum is the chosen institutional settlement layer. We're moving beyond years of closed, private blockchain experiments that largely went nowhere.
That's a massive endorsement. So what about the reserves? Given the banking crises we saw, that's the first thing institutional investors ask. How safe are they?
This hits the holy grail of stablecoin safety. So SoFiUSD is backed 1.1 by cash reserves held directly at the Federal Reserve.
Not at a commercial bank, at the Fed itself.
Exactly. This eliminates commercial bank counterparty risk. It eliminates any liquidity mismatch. When you hold $1 of SoFiUSD, that dollar sits securely at the Fed.
So this isn't just about SoFi making their own token. They're positioning themselves to sell this infrastructure to others, aren't they?
Absolutely. The strategic implication here is creating an infrastructure as a service model. They can now allow other banks and fintechs to white-label compliant stablecoins using SoFi's regulatory and technical stack.
Which lowers the barrier to entry.
It instantly lowers the compliance barrier for hundreds of regional banks.
And what about the immediate utility? I mean, where does this stablecoin get used that matters for Bitcoin's long-term adoption?
The utility is instant settlement. SoFi owns Galileo, a major payment processing arm. Integrating SoFiUSD facilitates immediate, real-world 247 cross-border remittance and merchant settlement.
So it's not just for trading.
Not at all. This shifts stablecoins from being just trading collateral to a core piece of global payment infrastructure. It drives adoption based on measurable utility, not just speculation.
That infrastructure breakthrough links perfectly to the next structural tailwind, and that's the decisive shift in U.S. regulatory leadership. This week brought two key confirmations that should finally put the regulation by enforcement era behind us.
That's right. The Senate confirmed Michael Sillig as the 15th chairman of the CFTC.
The Commodity Futures Trading Commission, the big one for crypto.
The primary regulator for digital commodity spot markets like Bitcoin and Ethereum.
Yeah. He was confirmed with a fairly tight vote, 53 of 43, but he's in. And at the same time, we saw Travis Hill confirmed as chairman of the FDIC.
And the FDIC, the Federal Deposit Insurance Corporation, plays a critical role in how banks interact with crypto firms. This dual leadership changes the entire risk calculation for institutional capital waiting on the sidelines.
So Sillig's philosophy is known as the minimum effective dose of regulation. What does that mean in practice for the industry?
It means a huge pivot away from the previous administration's philosophy of using lawsuits and threats to manage the industry.
Regulation by enforcement. Yeah.
Exactly. The Sillig's explicit goal is to establish clear, written rules for digital commodity spot markets. Institutions hate uncertainty, and clear written rules are the antidote to that.
And Hill at the FDIC solves the other half of the problem, the banking access issue.
Precisely. Hill has been a very vocal critic of what's been called Operation Choke Point 2.0 tactics.
That was the unofficial pressure on banks to not serve crypto firms.
Yes, the pressure to debank legitimate crypto firms. His leadership is expected to normalize banking access for the industry. This reduces systemic risk by ensuring crypto businesses can bank openly and safely, rather than being forced to use offshore or unregulated avenues.
So these confirmations are essentially dissolving the shadow ban that kept U.S. institutional capital hesitant. They're finally preparing the structural guardrails needed for massive allocators to enter the market next year. Okay, we've established these huge structural victories, but we have to face the short-term tactical reality. Institutional investors are showing immediate caution, which brings us right back to price action.
And that is the divergence in full display. The data for December 18 shows U.S. spot Bitcoin ETFs recorded net outflows of $161 million. That certainly looks like the market is selling.
$161 million in a single day is a significant outflow. Does this signal that the institutions are universally panicking?
No, and this is the key divergence that requires a deeper look. The selling was not uniform at all.
How so?
Fidelity's FBTC saw the heaviest pressure. It recorded massive outflows of $170 million.
So that one fund was responsible for the entire net negative figure.
Exactly.
So who is buying?
BlackRock's IBIT actually bucked the trend entirely. It recorded net inflows of $32.76 million. This suggests rotation or rebalancing, not panic.
Why would Fidelity's clients be rushing for the exit while BlackRock's clients are still adding positions? What's going on there?
We can speculate on a few reasons. First, timing. Fidelity's heavy selling could be related to tax loss harvesting or just year-end portfolio rebalancing that often happens in Q4.
Especially among retail and wealth management clients.
Exactly. And second, the institutional mandate. BlackRock often attracts larger, sticky institutional mandates, pensions, endowments that allocate for multi-year horizons and are less reactive to immediate volatility. The smart money floor is still holding.
The market is certainly fragile, though. It feels driven by derivatives positioning. We saw volatility flush over $484 million in leveraged positions in just 24 hours.
That volatility is absolutely being exacerbated by the derivative structure right now.
Well,
We have to acknowledge the calendar risk of witching Friday.
okay.
There's heavy put-open interest, meaning the right to sell acting as a price magnet right near the $85,000 strike price for options expiry.
Hold on. For those of us not in the derivatives pit, what exactly is short gamma and how does that affect the current volatility around that $85,000 magnet?
That's an essential concept right now.
Yeah.
When dealers, the institutions facilitating those options trades, are short gamma, it means they have to hedge their books.
So what do they do?
If the price drops toward $85,000, they are forced to sell Bitcoin to stabilize their position. If the price rallies, they're forced to buy. This mechanism just exacerbates volatility on both sides.
It creates wider swing.
Wider swings, exactly, until that options expiry event is finished.
So where are we trading right now, and what are the key technical levels to watch until this derivatives volatility passes?
We're trading at approximately $87,984. The $85,000 level has established itself as the critical line in the sand.
The line in the sand.
It's a key demand zone, a high-volume node. Losing $85,000 means a sustained break that likely opens the door quickly to $80,000. For the upside, immediate resistance is at $89,200 and then at $92,500.
To close the loop on this divergence, let's look at the ultimate counterpoint to the ETF selling, corporate treasury strategy. BitMine Immersion Technologies is executing an aggressive accumulation strategy focused not on Bitcoin, but on Ethereum.
It's a concentrated, high-stakes bet. BitMine currently holds approximately 3.97 million ETH.
Which is valued at over $11.8 billion.
Right. And they are not shy about their goals either.
They have a very explicit, audacious goal they call the alchemy of 5%.
Correct. They aim to control 5% of the total circulating Ethereum supply. They currently represent about 3.2%. What's really important is their latest activity. BitMine acquired an additional 30,075 ETH worth about $88.7 million in the last 24 to 48 hours.
What's the implication of this corporate accumulation against the backdrop of ETF investors selling their Bitcoin holdings?
It's what you'd call price-insensitive buying. BitMine is treating this market dip not as a reason to panic, but as a critical liquidity event.
A chance to acquire more supply at a discount.
Exactly. This provides a frantic floor for ETH, absorbing supply and preventing a deeper collapse. It confirms that while passive investors may flee volatility, sophisticated corporate treasuries are using these periods of stress to aggressively accumulate. It fundamentally supports the asset class.
Although we have to note that strategy does concentrate significant risk in one single entity.
Oh, absolutely. A huge concentration of risk. To synthesize this for you, the listener, we are stuck in a valley of divergence. On the one hand, the structural foundation is solidifying. A nationally chartered bank, SoFi, is using Ethereum as a settlement rail, and the U.S. is installing pro-innovation regulatory leadership at the CFTC and FDIC. That structural thesis is stronger than ever.
But the tactical picture, the tightening global liquidity driven by the BOJ's pivot in short-term ETF selling, is demanding caution. The tactical risk is acute, even if it might be temporary.
The two most actionable takeaways you need to have in your operational model today are, first, watch $85,000 on BTC. That is the critical technical support level. Losing that confirms further short-term weakness.
And second, monitor USDJPY. If the yen strengthens rapidly and USDJPY drops below 154, expect an immediate high correlation sell-off in Bitcoin as those highly leveraged yen carry trades are forced to unwind.
And, you know, the structural shift we discussed, a nationally chartered bank issuing a stablecoin on Ethereum, fundamentally alters the value proposition of ETH. It moves from being purely a speculative asset to a productive commodity required for banking operations and infrastructure.
The question for you to mull on this week is, how long can tactical risk outweigh a structural revolution this profound? Something to chew on until next time.